For the first time in decades, listed property companies and funds are now delivering distribution or income growth that is below inflation. As a result, consolidation in the sector is on the rise. This is Portfolio Watch, and I'm Fifi Peters. Tonight, we're going to look at this phenomena and delve into the JSE's rapidly declining listings and ask where to find value in what's left. But first, JSE-listed property companies are currently in a state of flux. Safari has put in a bid for Fairvest, Arrowhead Properties and Gemgrow are weighing a merger. Arrowhead intends to reduce and ultimately dispose of its holdings in Rebosis and Dibula. And then there's RDI REIT, which is facing its own headwinds. Amid all this turmoil, where do you find value? Joining me to unpack this is Keillen Ndlovu, Head of Property Funds at Stanlib. But Keillen, thanks so much for your time. So much going on in the property sector right now, but let's actually look at the deals that are on the table. Which ones are looking attractive to you?
Well, I guess what we've seen now is most of the deals happening actually on the smaller listed property companies, as you mentioned, Fairvest and Safari, as well as Arrowhead and Gemgrow. So it's actually good because we've got so many companies, almost 50 listed property companies in our space, and it makes sense actually to consolidate some of the smaller listed entities. So we're seeing that happening. And also SA Corporate as well. There's been probably 1 or 2 or 3 kind of interests on that fund. Right. After management actually changes or shake-up. So we may see something happening there as well. And actually there's been so much talk as well on other listed companies as well, but we haven't seen any tangible deals coming up, but we expect actually the next 6 months to be quite interesting. So it helps with the liquidity as well, and actually having concentrated companies as opposed to smaller ones.
Yeah, but what about profits though, and ultimately the benefits to your portfolio? Because you do talk about the fact that there's just too much supply out there in the market right now. The economy is tough, and therefore it makes sense for a lot of these companies to come together. Yes. So I mean, if we just unpack those 3 deals that we did, that we announced, Fairvest and Safari, Gemgrow, Arrowhead, even your SA Corporate real estate, which ones would you be buying and why?
Well, I guess probably most of the deals are probably more earnings neutral as opposed to actually earnings enhancing, but we're going to see probably medium to long-term benefits, which is actually mainly liquidity and size. And that helps its companies as well when it comes to funding and improving actually the shareholder base. Most of the fund managers don't like to invest in the smaller counters. Some of them, they're not in the benchmark. When you get bigger, you get included in the benchmark or in the indices, and then you attract more actually fund managers into the portfolios. All right.
Yeah. So much of this consolidation at this stage is between the smaller players, as you have just mentioned, because the economy is so tough, and because, as you know, we mentioned at the top of the show, distributions are growing at a pace that is below inflation for the first time in many years. Sure. Are we expecting to see a similar kind of M&A activity amongst bigger players?
So they may actually probably mid-cap companies as well. It could, if it's actually the strategies are similar, whether it's retail focused or industrial focused, but it's going to be largely at a smaller scale or smaller listed companies before move into the mid-caps. So a good example would be SA Corporate at this stage.
Okay, yeah. But then ultimately the property sector, you said that most of these deals are earnings neutral, and if you want to buy some of these stocks right now, you need to take a long-term view. Explain to us how long that view is, because I mean, property is just like the economy in a state of flux.
Yeah. So our message to clients is that actually we may see things get worse before they get better, and we advise investors to look beyond 2019. So probably focus more on 2020 going to 2021. Because we're going through that adjustment period from earnings, from mergers and takeovers, even fundamental as well, and need to see the economy actually pick up to help these companies actually to improve that distribution growth from the 2 to 3%.
Yeah, I mean, in terms of some of the other fundamentals or factors that are currently affecting property right now, we mentioned the economy and the oversupplied market and the fact that tenants are under pressure. But also, one thing that has been quite dominant is the issue of governance, corporate governance, particularly amongst the resilient group of properties. That share price, the resilient group, I see that it's had a better first half of the year than it has in quite a while, up to some 6% or so. I mean, does that reflect that you guys as investors are no longer worried about some of the allegations against those group of companies?
I guess we've seen some of the actual announcements coming through from the FSCA. So one that's actually been totally cleared will be NEPI of all the allegations. And so far, we've seen actually positive news coming out of the FSCA, but there's still actually outstanding issues, mainly with Fortress, Resilient, and Green Bay. NEP is the only one that's actually been cleared of everything. So it gives the market a bit of comfort that, one, there's progress from the FSCA, and people actually understand what's going on. There was a time when actually the market waited for so long to see what's actually happening within that stable.
But then do you then, now that there's a lot more clarity, although it's still open cases, as you do say, regarding false and misleading statements and price manipulation in some cases, do you still buy these group of companies given their dominance in South Africa's property market, or do you hang 10 at this stage?
Well, if you look at the valuation as well, they've adjusted quite a lot from the beginning of last year. So we believe actually most of the news is priced in, compared to where they were before, where they're trading at huge premiums to net asset values. Now the stocks are trading probably in line or even at actually a discount to net asset values. So they're more in line with the market compared to actually beginning of last year.
All right, so that sounds like you're saying yes.
Kind of, yes.
All right. The merger with, going back to the merger with Arrowhead and Gemgrow, because Arrowhead, there was also a sudden resignation of a CFO and also the founder of that company. Any details? Because the company wasn't very forthcoming with why there was that sudden resignation.
Well, actually, it's basically what they said in the announcement. So there's nothing more we can say over and above what they said. And probably look forward to what's the plans as well to actually improve the management quality, with the absence of actually one of the key members who was there since basically listing.
So, but does this raise concerns for you guys as Stanlib, or do you believe that the company and its fundamentals and its strategy are still intact, and therefore you still hold your Arrowhead, and when they merge with Gemgrow, it's still a buy? Well,
I guess as Stanlib at this stage, we don't hold any of the group. We were underweight those companies. Probably just maybe talk about the corporate governance as well. We're going through actually the SA REIT Association, focus on best practice recommendations. That's probably another area to look at, where companies report actually their financials in different ways, whether from NAV or capitalizing interest. So going forward, we're going to probably have more standardized actually reporting. We actually can compare companies, actually have a like-for-like comparison in terms of companies.
I mean, Keillen, what we also haven't spoken about is the fact that, South African companies, including property companies, have been looking for growth outside of South Africa as things slow down. And what's interesting is the rate at which property companies now have offshore exposure compared to 10 years ago. You say it's moved up from 0% to like
47%, yeah.
So what's the outlook there? Do you expect to continue seeing this grow?
Yeah, actually we prefer offshore exposure to local exposure at this stage. So if you look at our growth outlook of 2 to 3%, if you were to exclude actually offshore exposure, that number will be negative 3 to 4%. So most of that 47% exposure, almost 60% is actually, of the 47% is Eastern Europe. And those companies are still delivering between 6 to 10% distribution growth, which is good for the sector.
But for how long? Because the Eastern European story has been a positive one for the property companies that are there. In fact, I remember speaking with a Growth Point CEO, Norbert Sass, and he mentioned how Growth Point was actually late to the party there, but was still quite bullish. But for how long can Eastern Europe continue to keep investors smiling? Well,
I guess coming back to, if you look at NEPI as well, they were achieving over 10% distribution growth. And now the last number is about 9 to 10%, and then the outlook is 6%. We think more normalized growth is around the 5 to 6% levels, and NEPI is approaching those levels. So even the normalized growth is still actually much higher than South African companies that are actually achieving negative distribution growth.
I mean, just taking stock of where we are, Keillen, also in as we're at the halfway mark of the year, and we're looking forward to 2019. I was just looking at some of the biggest losers on the JSE so far, and this is a conversation we're going to have later on in the show, but two property companies stand out there. It's Rebosis and Delta. Share prices down around 70 and 50% respectively. What's your take on those two companies and where they're headed and whether one should hold them?
Well, they're going through a tough period. The biggest issue is actually their loan-to-value ratios, and you've seen the earnings decline as well. So they have to fix their balance sheets, and actually they're the only two companies that actually cut their distribution, or their payout ratios basically. So Rebosis actually skipped paying the interim distribution, and they're hoping to pay the final distribution. whereas Delta reduced their payout ratio from 100% to 75%. So they're retaining some of the earnings actually to help service actually the interest bills. So we may see that kind of trend actually pick up in the sector, where you find that companies reduce their payout ratios.
And is that because of the tough times? Or is it because, as you did mention in your research note, that South African companies are quite unique in paying out all their earnings as distributions?
Yeah, I guess probably the biggest issue is actually the loan-to-value ratios. They're approaching the 40% levels. That's the highest number that we've seen actually in the listed property sector. So if at 40% becomes actually, and the equity market is challenging, it's difficult to raise equity to fund actually developments, and you find that companies actually the best way actually to have some extra cash will be to reduce your payout ratios and use that money actually to whether service interest bill or actually refurbish or do something with their portfolios.
But ultimately, Keillen, I mean, if in terms of your top picks in the property sector right now, where would you be putting most of your money on, and why? I
still like actually companies with a bit of offshore exposure offshore exposure, and our top picks in the portfolios at this stage are still equities. They're in the right market, in the industrial space, in the logistics space. That's actually the strongest sector right now in the global markets. And also like storage, which is basically a totally unique sector, niche sector in the storage market, and they've got less competition there. And what we like about both companies, they've diversified into offshore markets. They've diversified actually into the UK. You may question about the UK with Brexit, but they're in the right markets. Logistics still does well in the UK, as well as actually our self-storage. Yeah,
what about, I mean, into there in the UK and not having a great time there, as well as Hammerson? So the Brexit story for property companies that are there, what are the major risks or even opportunities?
Yeah, I guess probably with Into and Hammerson, the biggest challenge is the retail sector. You want to be out of the retail sector at this stage in these markets, because online shopping actually continues to grow, and they've had actually all these companies actually failing and all shutting down and asking for actually rescues packages. That's the biggest challenge, as well as actually the loan-to-value ratios. So Into actually they're struggling with the debt levels, and actually they've probably first reached in the UK to actually skip paying out actually their dividends, so as to service the interest.
Keillen, just as we wrap up and bringing things back home, I mean, with the outlook for the South African economy being weak at best, and also just breaking down, I mean, consumers are under pressure and therefore not shopping in malls as much. Business confidence is low, and therefore office uptake is it's not what ideal levels should be. I don't know, just locally, is it the industrial sector that will provide much of a buffer, or what?
Yeah, probably industrial sector will be the strongest sector, relatively speaking, in a weak market. And the challenging sector right now, probably office market and retail kind of similar, because retail sector hasn't actually been doing that well, and actually it's been worsened by actually increased supply. We've got big malls opening up, so much competition, limited spend. And office market, though we've seen probably the biggest actually buildings actually opening up now, there's less speculative buildings coming through going forward, but there's still so much space. So relatively speaking, we prefer the industrial sector.
But ultimately, if you still want to stay in the space, be prepared for lower distributions, but it is a long-term game, and make sure that you've got quite a lot of picks in your portfolio that are facing offshore.
That's right.
Sure. Keillen, thanks so much for your time.
Pleasure.
Let us leave it there. Of course, I was in conversation with Keillen Ndlovu, who is the head of property funds at Stanlib.